if you're doing retirement planning, estate planning is just one subset of that from my perspective. This capital gains tax change has changed that world. I'm going to skip over this and just talk about our conversations. But before I do so I should mention, when we pass away without a surviving spouse, right, our value of our RSPs or RIFs gets triggered for tax purposes, and all of our capital gains on taxable accounts. And that can include if we have a vacation property or a second home in Phoenix, right? We've got a right place in Canmore. The gains on those properties also gets captured, and it's not that hard to go above $250,000 in gains, meaning that higher inclusion rate can be a factor when we pass away. So managing those capital gains and also managing the amount that's sitting in RIFs, especially as we get older, can be an important part of estate planning. Of course, we've got on this slide, we've got, do you have a will? Do you have powers of attorney? What about those key documents? Does someone know where to find them? The plan for physical assets, right? We're showing a camp or cabin here. Can be one of the most contentious areas, right? You think you leave it to the kids and they're going to love it and get along with it. And what if they don't, right? What if one of the kids isn't interested in using it very often and another is, or maybe you've got more than two, so it gets even more challenging. Having those conversations, right? That's why we call this slide the tough but necessary conversations. Having those conversations in advance, figuring out what the kids actually really want, can mean that the long-term legacy is much, much better, right? You don't want the legacy to be fighting over an asset like a cabin. And that leads to that final comment there, bubble there on the bottom right. Family governance, are the wishes known, right? And it could be about the cottage. It could be about who's getting what. If you've got a corporation and it's an operating company and long term will continue to operate, which children are going to be involved in that business, which ones should get share ownership, right? Fair doesn't always mean equal, by the way. So having those conversations can be critically important. So Conrad, I think that brings us to the end of the formal presentation. What questions have come in that we can
so we got
address in the next few minutes?
We've had a couple of variations of the same question. So there's a couple of hot button issues out there, I think. And I would just encourage anybody that does have a question, please either email it to me or put it in the chat function in Teams here, and we'll make sure that we that we get to it. But we've had a couple of variations of one question around looking at, especially given your comments there on managing your RIFs as part of estate planning, is the wisdom or not of doing early withdrawals from your RRSP prior to the mandatory RIF conversion at age 72, or the mandatory first year of RIF income at age 72. Just a couple folks just looking for your thoughts on that.
And so a couple comments. First one is, I think, everyone is different, and remember that retirement paycheck and how we cobble it together. Everyone's scenario will be different. Again, going back to that idea, if you're delaying CPP and perhaps old age security till age 70, you certainly want to be taking money out in advance. Another factor is, what about the old age security clawback, right? If you're going to be subject to that, which, good problem to have, of course. It means you've got a fair bit of income in retirement, but to manage that, yes, there's another scenario where taking money out in advance from that RIF or RSP can be well advised. And put it into a TFSA, of course, would be our first choice. But once you've maximized that into taxable accounts, there are strategies that can be more tax efficient than others, such as things called corporate class funds, and they're investment funds that can bring tax advantages. So by pulling money out early and investing it, or spending it, depends on your the situation, but investing it. My mom, and it doesn't have to be pre-72, right? This could be my mom's 86. We're always pulling a little bit extra out of her RIF because it's about $300,000 in value, and if she passed away next year, the tax hit on that would be pretty hefty. So there's another example, we're pulling money out early, whether that's while you're still in your 60s or 86 like my mom, can make a lot of sense to manage that estate planning element as well. So there are a lot of reasons why that can make a lot of sense. This is, I'm sure, Conrad, part of your financial planning for retirement is looking at tax rates, when you first retire, and then as you start CPP and old age security and later phases of your retirement, and then the estate planning element, right? General rule is that we want to defer taxes wherever we can, but we also want to look at, we don't want to defer taxes now and only have to pay taxes in a few years at a much higher rate. So tax deferrals make a lot of sense. They're often the right strategy, but not always.
That's right. Yeah, and I would say that echo those comments. I mean, part of our financial planning process is that the program that we use actually has an artificial intelligence in it that actually does your taxes for the next 30 years, for instance, and looks at what's the optimal path for taking money out of an RSP to minimize things like clawback and such. And so, although it is a complicated answer, and there is a huge power for deferral, which is easy to underestimate. It really is. Deferral is extremely powerful, and it's like compound interest. You don't realize if you put 1 grain of sand on the first block of a chessboard, but you add 1, you double it every time, you end up with more sand than the Sahara Desert. Deferral is extremely powerful. So, we want to make sure we're thinking about that. We also have a question coming up here around order of withdrawal, right? So is it wiser to start with RIFs, TFSA, or non-registered? Again, our perspective would always be like, let's let we got the AI to optimize, we can optimize, but again, Peter, what are your thoughts on that as well?
And it goes back to that everyone's circumstances will be different, and I agree with that thought of the optimization will vary tremendously, and looking at the long range picture makes a lot of sense. I mean, often TFSAs are the last place you want to take them out of because they are so powerful from a tax perspective. But sometimes it can make sense that you want to do that because, for instance, if you need if you purchased a new car, right, and you need a certain amount of money, and you don't, your only other source is registered money, where you'd have, non-registered money, taxable accounts, where you'd have to trigger a big capital gain. So you don't want to do that. You take money out of TFSA, and you figure out how to replenish that over time. But so even within the context of, hey, we're going to leave TFSAs as long as we can, it may vary between different years depending on your particular spending needs.
Mm-hmm. Okay. I got one question here. I mean, I know the answer, but I'll let you answer it here, Peter. And that question is can you start by gifting what will be inheritance and avoid capital gains taxes after death? So can you avoid capital gains taxes after death by gifting early?
You can. Of course, to gift early, you need to generate the cash. Or you could donate the particular investment, but that also triggers the gain. So yes, it's absolutely a strategy to gift money early as part of the estate planning process. Of course, we want to be cautious that we make sure we've retained sufficient assets for living the life that we want throughout retirement, especially if we live longer than expected.
All right.
Is that how you'd answer it, Conrad?
Yeah, I would say you just want to make sure that the gains you trigger in making the gift doesn't make it worse. It doesn't put you in a financial position where you're not getting the retirement you're looking for, or the taxes you save are ends up puts you in a worse position, right? You don't want to. No one wants to pay these capital gains taxes, especially these new rates, especially that's 100% true in Alberta. But you also want to avoid cutting off your nose to spite your face. So I think we're all on the same page there.
Yep.
And I got one last question here, so I'll just sort of put this out as last call. If there's anything else we can add, but I think even though this is anonymous, I think I know who asked this question, so hats off. So if you have clients that are more growth, basically the gist of the question is that, the 4% withdrawal rate you talked about, Peter, I presume, and from what I've seen, that presumes a balanced portfolio. How
Yes.
far do you think you can push it if the client is more growth orientated? For instance, if you have a client that, is, let's just call it a growth or aggressive growth risk tolerance, how much can you move off of 4% and still be sustainable in your estimation?
Probably a fair bit, but it opens us up to what we call it's part of the withdrawal risk is the sequence of returns risk. If you have a significant downturn in the markets when you're pulling out significant amounts, if you don't have that conservative buffer to pull from, you're going to be triggering those losses and realizing those losses, and it can actually become a bit more of a challenge for the long term because of that timing, right? The markets don't just move up in a straight line over time. They move up and down, over the decades, for sure, over the years, over the decades. And there will be bumps from time to time, and the markets can stay down for, an extended period of time. They always recover, right? Conrad, has there ever been a market downturn where the markets haven't recovered from it?
No, I struggle to see that on the chart.
Yep, never. But nonetheless, by taking higher risk, you just have to be cautious that downturn can now maybe you cut your costs for a year or two to try and manage that, but depending on how much you have in the assets. And the other thing is, if you have more than enough assets, taking a little bit more risk because you're thinking about the next generation can also make sense.
That's right. Again, that's why when we look at, risk, tolerance is always, capacity and willingness. And if you have enough assets that's going to last your lifetime, then we can start taking a look at the time horizon that includes your heirs. And we do have several clients where they are well beyond the need for a growth portfolio, let's put it that way, but they still are fairly aggressively invested because they're not thinking on their time scale, they're thinking on their kids and their grandkids. So again, that's where we want to, rules that apply to at a general level don't necessarily apply to an individual. And this is why everything we do is personalized and worked out at the client level. I mean, this always comes down to the fundamental principle of know your client.
Everyone's different.
Everybody's different. So I think I put last call for questions out here. I haven't seen anything new pop into the chat, so I'm going to assume that I guess we're going to say, speak now or forever hold your peace. Oh, there we go. Any suggestions around planning since there hasn't, around the new capital gains tax increase, since there hasn't been any specific legislation?
That's a very good point. A very knowledgeable attendee who's aware that we haven't seen the rules. We've got June 25 coming up in a hurry. There are question marks. There are, there's lobbying going around about some of the aspects of these rules that don't actually make a lot of sense. And it's hard to plan when you don't see the rules. Now, they've promised to release the rules before they recess for the summer. That could be just a few days before June 25. And by the way, if you're going to trigger a gain before June 25, it has to be realized before June 25, which means if it's a stock or bond or investment fund, it has to be settled before June 25. But if it's an investment property or vacation property, it has to close before then, which is almost impossible, right, to make that happen. I do encourage people to think carefully and to work with their accountants to not do knee-jerk reactions on this, because you don't want to pay taxes earlier than you otherwise would have, unless it really makes sense, right? If it's something you weren't going to sell for 10 years anyways, I don't think you want to do that before June 25. If it's something you're going to sell in the fall, yes, or next year, yes, you may want to do that before June 25, but be thoughtful.
Yeah, absolutely. I mean, I would just say that the sum of what I've seen from probably sitting in now 20 meetings with accountants is, if it's a long hold asset like a cottage, or recreational property, don't do anything with this. Like, do not rush sales through, because you're probably likely going to hold it longer. The power of deferral comes into play there. If you have a very large, unrealized capital gain, and clients where that has been the case, we've done a very thorough combing of our client base, and we've engaged directly. So in some cases we are triggering. And a lot of it is just coming down to, we have to, take a guess on what the problem actually is. And, the part of, again, going back to what Peter was saying, we don't even have the rules. And yes, they promised something by June 21st, but here's the problem with that, is that there's not enough time to settle a trade. Even if they give us the rules on that Friday, there's not enough time for settlement. So we actually are forced to act prior to June 21, just because of settlement days in the market. So
yeah, although settlement date, it will be T+1 by then, right?
It will be T+1.
Well, I guess we are by now. Yes.
But,
anyways,
that does leave us, unless they do it first thing in the morning, it really leaves us no time to plan.
And
so, and Peter, thank you for pointing out that change.
But you've also got to assess the rules, not just have them in front of you, right? That's just, yeah. So anyways, I do have to jump because I've got
you have to go, but
presentation.
Thank you for coming in, and thanks for everyone for participating. And we'll look for, maybe we'll do an update here, in a year, 18 months from now, and look forward to your insights at that point, Peter. Thank you.
Conrad, thanks for having me on.
Thanks for being here.
All right. Bye-bye.
Bye-bye.